Hello, everybody. My name is Yaman, and I provide daily updates on markets and technology. Let's get started. Markets are mixed today. You can see chip stocks, Nvidia, Broadcom are down 3%, Oracle down 2%, JP Morgan down 2%. We're going to talk about that. Financials are generally up, though. Tesla's down 2%. Oil is at $58 per barrel. We're going to talk about that as well. Yield curve is a bit more steepened. 10-year treasury yield is at 405. Let's read the daily article. Wall Street dips as US China tensions simmer. Bank results pour in. Wall Street's main indices dipped on Tuesday as renewed concerns over US China trade conflict dampened sentiment. While investors parsed results from big US banks, which kicked off the third quarter reporting season. BlackRock's assets under management hit a record $13.46 trillion, and JP Morgan Chase raised its full year forecast for net interest income after beating expectations for third quarter profit. BlackRock shares rose 1% in choppy trading, while JP Morgan dipped 4%. Give me one sec. Okay. Goldman Sachs fell 5% despite beating Wall Street's expectations for quarterly profit. Citigroup slipped 0.9%, and Wells Fargo rose 2.9% after beating estimates for third quarter profit. S&P 500 banking index, which has outperformed the S&P 500 this year, dropped 1.4% despite strong results from major lenders. Quote, the most important thing to think about is not the actual earnings, which in large part were better across the board, but all of them are also trading at or near all-time highs, said Art Hogan, chief market strategist at B. Riley Wealth, on why many lender shares were lower despite reporting strong quarterly results. I mean, you could have just said valuations are high. Let's see. Okay. The earnings reports will help investors assess the impact of tariffs on corporate America and offer fresh clues on the economy at a time where major official data releases remain delayed due to an ongoing government shutdown. Investor focus will also be on Fed Chair Jerome Powell's speech at the NABE annual meeting for further insight into the U.S. Central Bank's monetary policy path. Nvidia fell 3.5%, Broadcom tumbled 4% a day after it surged almost 10% on its partnership with OpenAI. We're going to talk about that as well. S&P 500 consumer discretionary stocks declined 1.3%, with Tesla down about 3%. Defensive play consumer staples rose 0.5%. Markets had rebounded in the previous session after President Trump's conciliatory tone on trade tensions with China, as well as Treasury Secretary Scott Bessent's comments that the U.S.-China meet later this month remained on track. On Tuesday, Washington and Beijing began charging additional port fees on ocean shipping firms after Trump's threat to impose additional 100% tariffs on Chinese goods on Friday over Beijing's rare earth export controls knocked Wall Street main indices off their record levels. Additionally, IMF edged up its 2025 global growth forecast on tariff shocks and financial conditions being more benign than expected, while warning that a renewed U.S.-China trade war could slow output significantly. Chinese companies fell. Alibaba, JD.com declined 3%. Okay. More detail. Let's see if there's anything new here. Trade spats kick off for the third quarter earnings season. Retaliation from Beijing. Its latest moves to target U.S. shipping have undermined recently revived hopes that U.S.-China will avoid an all-out trade war. China has placed sanctions on 5 U.S.-linked units of South Korean shipbuilding firm Hanwha Ocean, effectively barring Chinese companies from doing business with them. Both countries also began charging special port fees on one another's vessels on Tuesday in a bid for maritime dominance. Also in focus is the third quarter earnings season, which kicked off in earnest. We're going to talk about those later. Key data reports stalled. September CPI, consumer inflation report, scheduled for Wednesday, has been delayed to October 24th, so 10 days from today. Data on retail sales and producer prices are also expected to be pushed back. I don't think Powell is going to say anything new. AMD said it will provide Oracle's cloud business with 50,000 AI chips. We're going to talk about that as well. And we're going to talk about JP Morgan. But first, auto sector bankruptcies spark fresh scrutiny of Wall Street credit risks. The bankruptcies of automotive related companies, First Brands and Trilocor, along with potential losses at banks and investment funds, are raising concerns about hidden risks in parts of the credit market, prompting investors to take a closer look at risky debt. Auto parts supplier First Brands and subprime lender and dealership Trilocor both filed for bankruptcy protection last month. The two collapses have rattled some stakeholders in Wall Street's multi-trillion-dollar credit machinery, from leveraged loans and collateralized loan obligations to trade finance funds and subprime auto loans, raising questions about exposure levels of a number of Wall Street fund managers, which pool capital from investors to provide loans to companies. Quote, this would serve as a strong precedent for LPs to question risk offerings, said Zain Bukhari, Associate Director of Risk and Valuations at S&P Global. LPs, referring to limited partners, are passive investors that provide capital to a fund. Some investors may ask for audited statements or qualitative earnings from independent audit firms before investing in unsecured assets, Bukhari added. First Brands had roughly $800 million in unsecured supply chain financing liabilities. Interesting. A sign of such scrutiny appeared in July when First Brands was trying to raise $6 billion loan to refinance its debt. In August, however, it became clear that potential lenders would require further diligence, including a quality of earnings report, according to a document filed by Auto Parts Company's chief restructuring officer in bankruptcy court. Investors and analysts are now assessing the fallout for the individual firms exposed as well as for the broader market. They hope to gain some clarity during the third quarter earnings season, which kicks off this week. The third quarter earnings become a very interesting litmus test on how this shakes out. People will be very close to following the bank reporting, said Andrew Sheets, global head of corporate credit research at Morgan Stanley. There will be big questions about where auto loan trends are and other consumer credit charge-off trends are. First Brands filed for bankruptcy protection on September 29, listing more than $10 billion in liabilities. Some of the finance industry's most prominent names, including Jefferies and UBS Group, have since disclosed exposure of more than $1 billion tied to the collapse of the Ohio-based company. Earlier in October, Jefferies said a fund in its assets management division, Liquida Asset Management, has about $715 million of receivables tied to First Brands. UBS is assessing more than $500 million of exposure across certain funds. Some investors have asked Jefferies linked Point Bonita Capital's fund to return money invested in the fund, a source familiar with the matter told Reuters. On Sunday, Jefferies said the exposure to First Brands Group is limited and that any potential losses would be readily observable. When Jefferies was asked if it will face pressure from investors on more scrutiny on risky investments, a spokesman for the firm declined to comment on Monday. Other banks exposed include South State Bank and CIT Group, which is now owned by First Citizens. A broad range of funds, including Sound Point Capital Management, Benefit Street Partners, and Palmer Square Capital Management, hold CLOs, which collectively hold hundreds of millions of the $4 billion of first lien term loans of First Brands, according to court documents. Investment firms with over $100 million of CLO exposure each include AGL Credit and PGIM, according to recent court filings. Interesting. The funds and banks either declined to comment or did not respond to requests for comment. A UBS spokesperson said the bank was working to determine the potential performance impact on the small number of our affected funds. Meanwhile, Trilocor listed over $1 billion in liabilities with more than 25,000 creditors, according to its bankruptcy petition. Lenders such as JP Morgan have nearly $200 million of exposure to Trilocor, Reuters had previously reported. The credit rally, which got off to a robust start earlier in October, has hit a speed bump in recent days as investors reduce exposure to certain sectors over concerns around weakness in consumer and auto lending, experts said. Okay. All right. I think we covered that. Early warning signs. Let's move on to small business sentiment that was announced this morning. We get very few data releases these days, so let's focus on this a little bit. EBS in September, inflation back in focus. That's a nice picture. A U.S. small business sentiment declined in September amid expectations of unfavorably operating conditions in the next 6 months, and many owners reported raising prices or planning to, suggesting that inflation was poised to increase further. The National Federation of Independent Business said on Tuesday its small business optimism index dropped 2 points to 98.8 last month. It was the first decline in 3 months. A lapse in government funding amid the political standoff between Republicans and Democrats in Washington has halted the collection and publishing of official economic data, leaving investors and policymakers relying on private surveys to assess the economy's health. The shutdown, which enters its third week on Wednesday, has delayed the release of the closely watched employment report for September. But September's consumer price data will be published next Friday to assist the Social Security Administration with its annual cost of living adjustment for 2026 for millions of retirees and other benefit recipients. The NFIB said the survey's uncertainty index jumped 7 points from August to 100, the fourth highest reading in over 51 years. Uncertainty is very high. The Trump administration has a lot of policy changes still in the air, lots of moving parts, said NFIB chief economist Bill Dunkelberg. Growth in the economy is solid, though driven perhaps more by AI related investments than spending that impacts Main Street firms. Tariffs are raising costs for businesses. The share of owners expecting better business conditions over the next 6 months plunged 11 points to 23%. The commentary from survey respondents included complaints about higher beef prices, health insurance, and taxes, as well as potential clients choosing to delay or forego repairs or improvements due to the lack of confidence in the overall economy. 14% of owners said inflation was their single most important problem in operating their business because of higher input costs, up 3 points from August. The share raising average selling price increased 3 points to 24%, with the NFIB noting that price increases remain above the monthly average of a net 13%. There was also a rise in the proportion of complaining about supply chain disruptions affecting their businesses. You could have said highlighting. The price increases and supply chain disruptions are likely because of President Donald Trump's sweeping tariffs on imports. Trump last Friday threatened 100% duties on Chinese imports. About 31% of owners plan to raise prices in the next 3 months, up 5 points from the August. More businesses reported declining sales, and the share expecting higher inflation adjusted sales dropped 4 points. As a result, unsold merchandise is piling up, a worrying sign for the economy. Solid consumption spending appears to be from the top third of the income distribution, and the stock market keeps setting new record highs, producing capital gains income for shareholders, said Dunkelberg. Okay. Let's look into JP Morgan. JP Morgan's diamond on true record losses. It is not our finest moment. JP Morgan Chase CEO Jamie Dimon offered a mea culpa and a warning Tuesday when discussing the losses his bank experienced from the downfall of subprime auto lender Trilocor Holdings, saying, "It is not our finest moment, and when you see one cockroach, there's probably more." Yikes. Damn. That's pretty crazy. That should be the headline. Diamond and his CFO discussed the Trilocor impact on calls with reporters and analysts while disclosing a $170 million charge-off, a measure of unpaid debt written off as a loss related to its wholesale lending to the subprime lender. Quote, "When something like that happens, you could assume that we scour every issue, every universe, everything," Diamond told reporters while admitting that it was not our finest moment. You can never completely avoid these things, but the discipline is to look at it in the cold light and go through every single little thing, which you can imagine. We've already done, and maybe there might be more to do, Diamond added. My antenna goes up when things like that happen, Diamond added when speaking with analysts later on Tuesday morning. I shouldn't say this, but when you see one cockroach, there's probably more, Diamond added. Triloco filed for bankruptcy in early September. The collapse of the Dallas based subprime auto lender has been linked to allegations of auto loan fraud affecting multiple banks. JP Morgan Chase CFO Jeremy Barnum revealed this $170 million charge off on the calls with reporters and analysts. We're not in the habit of calling out exposures of individual borrowers, especially for amounts immaterial. But given the amount of attention, we might as well not dance around it, Barnum said. Along with JP Morgan, Fifth Third Bank and Barclays have also appeared as creditors in Trilocor's bankruptcy, according to court filings. Fifth Third disclosed its exposure to Trilocor in September, saying it expects to take $170 million to $200 million loss on so-called asset-backed loan to Trilocor. Tricolor. Yikes. I've been pronouncing it wrong. The Tricolor loss did little to drag down results at JP Morgan, which, like other big banks, rode a surge in deal making over the second half of the summer. The country's largest bank reported a 12% jump in third quarter profits, about $1 billion more than analysts anticipated. But the fall of Tricolor and larger bankruptcy of auto parts supplier First Brands have captured attention on Wall Street. And investors are looking for signs that credit among commercial customers is weakening. JP Morgan's net charge-offs did rise 8% from the second quarter to $2.6 billion, driven by higher write-downs within its massive commercial and investment banking division. Interesting. Let's stick with banking and go to Goldman. Goldman's profit beats estimates as deal-making rebound boosts investment banking. Goldman Sachs beat Wall Street expectations for third quarter profit on Tuesday as its investment bankers earned higher advisory fees and rallying markets boost revenue from managing client assets. The bank's prediction for a banner year for deal making has materialized as corporations revive plans for mergers and listings. Goldman's investment banking fees surged 42% to $2.66 billion in the quarter ended September 30 from a year ago. Analysts were expecting 14% increase, according to the average estimate compiled by LSEG. Goldman executives said the firm advised on $1 trillion in announced mergers and acquisitions year to date, $220 billion more than its next closest competitor. It advised Electronic Arts on its $55 billion sale to consortium of private equity firms and Saudi Arabia's public investment fund this year, and also advised Holcim on the spin-off of its North American business, Amrise, now valued at $26 billion. Goldman also advised Fifth Third Bancorp, the bank we were just talking about, which this month agreed to buy regional lender Comerica in a $10.9 billion deal to create the ninth largest U.S. bank. Interesting time. The growth was fueled by a 60% surge in advisory fees, while debt and equity underwriting fees also increased. Rival JP Morgan Chase also reported robust investment banking numbers. Goldman shares fell 5% early trading as analysts said the trading business underperformed market expectations, even though financing for that segment was strong. The shares have surged 37% year to date. This quarter's results reflect the strength of our client franchise, etc., etc. We know the conditions can change quickly. Blah, blah. Staff reduction rolls out AI. Goldman separately informed employees of potential job cuts and hiring slowdown through the year end, according to an internal memo seen by Reuters, as Wall Street giant aims to use AI to enhance productivity. I think this last part is a bit of a bullshit. And there's lots of hiring slowdown going on right now into the year end in many industries. But let's see what they say. The rapidly accelerating advancements in AI can unlock significant productivity gains for us, and we're confident we can reinvest those gains to continue delivering world-class solutions for our A spokesman for the firm said the company still expects to finish with a net increase in overall headcount this year. Solomon, the CEO, also told analysts that the regulatory environment is improving the firm's competitive position significantly. Quote, "We're going to see a much more constructive Basel III endgame," end quote, he said, referring to the final set of proposed bank capital rules. Solomon said he expects relief in supplementary leverage ratio by next summer, more transparency around comprehensive capital analysis and review, as well as rules for global systemically important banks. Global M&A volumes for the first 9 months of the year crossed $3.4 trillion, with nearly 48% of it in the US, according to data from Dealogic. The period also saw the highest average M&A volume globally, and in the US since 2015, in line with Solomon's prediction at last year's Reuters Next conference. Goldman was among the joint book running managers on marquee initial public offerings in the quarter, including design software firm Figma, Swedish fintech Klarna, and space tech firm Firefly Aerospace. The CFO said quarter end deals backlog is the highest levels in 3 years. Quarterly profit of $4.1 billion. Wow. That's more than Tesla. There's a lot more than Tesla. Capital markets machine has clearly shifted into higher gear with robust stock prices, a reduced regulatory burden, and the prospect of lower interest rates likely to keep the momentum going. Goldman executives had been increasingly optimistic about deal making in recent months, with Solomon saying in December it had one of the busiest weeks of IPOs in more than 4 years. Revenue from asset and wealth management rose 17% to $4.4 billion, marking the first quarterly jump this year for the segment. This reflected record high management fees as well as private banking and lending revenue. The business is a key priority for Goldman as it seeks steadier revenue from fees, which offset the volatility in its advisory and trading businesses. Goldman said last month it would take a stake worth as much as $1 billion in T. Rowe Price as part of a partnership to tap the asset manager's retirement money for alternative assets. Interesting. Assets under supervision climbed to $3.45 trillion, boosting management fees by 12%. Goldman set aside $339 million as provisions for credit losses, compared with $397 million a year ago. The provisions were mainly related to its credit card portfolio. Okay, we're going to skip that part. We talked about that. Let's go to this. Before that, do we have any more financial? Let's do one more financial news before we switch to other stuff. Wall Street sees major jump in profits helped by soaring stock prices and deal making. Let me just kind of skim through this. If there's anything we cover, JP Morgan. Consumer banking division had a particularly strong quarter, partly driven by its credit card business. So this wasn't in the other article. The bank has seen consumers spend more, borrow more, and be willing to carry a balance on their cards for longer. The bank also upgraded its Chase Sapphire Reserve card this summer, which launched a summer of refreshes by the major credit card companies to keep customers spending on the bank's high-fee cards. Okay. Along with the consumer that seems to be holding up, Wall Street is having one of the best years in deal making. Okay, we just talked about that. Particularly AI firms raising tens of billions of dollars. EA. Okay. Nothing else new here. All right, let's switch to the sticker shock. Sticker shock. Car prices top $50,000 for first time in US, Kelley Blue Book says. Tariffs and pricier vehicles catering to wealthier buyers are driving the new vehicle market higher. Give me 1 second. With car prices chugging higher in the US, it was only a matter of time before window stickers crossed the $50,000 mark. According to Kelley Blue Book, the average transaction price of a new vehicle in the US topped $50,000 for the first time, reaching a record high of $50,800. $50,800. KBB, which is part of Cox Automotive, said prices were up a hefty 2.1% sequentially from August and up 3.6% year over year. The 3.6% jump in September was the largest gain in over 2 years. We've been expecting to break through the $50,000 barrier. It was only a matter of time, blah, blah. Pickup trucks Ford that routinely cost north of $65,000 are highlighted. Wealthier households drive the current auto market for new cars because those buyers have access to capital. The $20,000 market for cars is extinct, Keating said, with lower income and price conscious buyers perusing the used market. The most recent CPI data from August confirms what KBB observed in September. The Bureau of Labor Statistics reported that new vehicle prices were 0.3% in August, were up 0.7% year over year. Even the used vehicle market saw price inflate up 1% in the month and 6% year over year. Due to the government shutdown, September has been delayed. One big factor boosting prices has been tariffs, KBB said, which have not surprisingly introduced new cost pressure to the business. While a number of tariff deals have been struck, the overall rates are now higher, and frameworks for deals in some countries are still not finalized. Most important for U.S. buyers, negotiations between U.S., Mexico, and Canada are still in limbo. Current tariff rates for exported vehicles built in Mexico and Canada, the vast majority of which are destined for the U.S., still stand at 25%. In addition, a mix of pricier EVs and higher-end vehicles push new car average transaction prices higher. The expiration of the federal EV tax credit on September 30 pulled forward a higher amount of EVs that would otherwise have been sold, which caused prices to jump. KBB estimates the U.S. EV market share hitting 11.6% in September, a record high, with the EV transaction price crossing $58,000. Looking ahead, KBB projects the situation won't get any better next year. KBB reports the average new MSRP, which differs from the average transaction price because it includes incentives, reached a record high in September of $52,183, a 4.2% year-over-year jump and above the long-term average. Okay. This figure is forecasted to drop to 5% in Q4 by Ford's CEO. Right. Moving on to other companies. Walmart partners with OpenAI for ChatGPT shopping feature. Walmart said on Tuesday it was partnering with OpenAI to enable customers and Sam's Club members to shop directly within ChatGPT using the AI chatbot's instant checkout feature. Wow. Walmart shares were up 3% in early trading on Tuesday. That's going to hurt Amazon. This is going to hurt Amazon. The tie-up follows a similar partnership OpenAI announced last month with Etsy and Shopify, which sent the online seller shares soaring. Walmart, the world's largest retailer, is expanding its use of AI as companies across sectors adopt the technology to simplify tasks and cut costs. Earlier this year, Walmart laid out plans to roll out a suite of AI-powered super agents to improve the shopping experience and streamline operations. Interesting. Let's just read the summary on this one. You know what? Let's just read it. Who cares? The impact of President Trump's tariffs is expected to weigh on economic growth worldwide in 2025, according to IMF's New World Economic Outlook released Tuesday. The outlook for the global economy continues to point to dim prospects, both in the short and long term, according to IMF report. Global growth is projected to decelerate to 3.2% this year from 3.3% in 2024 and skid further to 3.1% in 2026. While effects on supply chain inflation have been muted so far, the IMF warns higher price and costs are likely to be passed on to consumers, potentially leading to higher interest rates in the US. Let me just skim through it. No, nothing new. Moving on. OpenAI Broadcom partner on AI hardware. I want to see the details on this. OpenAI has landed a new hardware partner. The AI Research Lab announced Monday it formed a partnership with semiconductor company Broadcom for 10 gigawatts worth of custom AI accelerator hardware. These AI accelerator racks will be deployed to OpenAI data centers and partner data centers starting in 2026 and running through 2029. By designing its own chips and systems, OpenAI can embed what it's learned from developing frontier models and products directly into the hardware, unlocking new levels of capability and intelligence, the company said in a press release. So they basically secured tens of gigawatts of AI compute for the next 5 years by partnering with all these companies. But, you know, a lot of people have concerns around the electricity supply for these data centers. And so that's the question that's, I think, still unanswered in my mind, at least. While terms of the deal were not disclosed, the Financial Times estimated it could cost OpenAI estimated $350 billion to $500 billion. Last week, OpenAI announced it was purchasing an additional 6 gigawatts of chips from AMD in a deal worth tens of billions of dollars. In September, NVIDIA announced it was investing $100 billion in OpenAI alongside a letter of intent for OpenAI to tap 10 gigawatts worth of NVIDIA hardware. OpenAI also allegedly signed a historic $300 billion cloud infrastructure deal with Oracle in September. Neither company has confirmed the deal. TechCrunch reached out to OpenAI for more information. I don't think these deals will materialize, but we'll see. We talked about this. Couple more news. One macro, two micro. Oil tumbles to 5-month low on report of a large supply. Oil prices fell to a 5-month low on Tuesday after a report from the IEA estimated a recent large surplus of crude supply. Brent dropped as much as 3% to touch $61.50 a barrel, its lowest since early May, and was later down 2.3% on the day. The fall came after the agency said preliminary data indicated a massive buildup in oil shipments in September, following a surge in exports by key producers, suggesting that output is now more than consumers need. The overhang will average 3.2 million barrels a day from this month through June 2026, according to the IEA. It had previously estimated a surplus of 2 million barrels per day to last well into the next year. That's a big jump. If a buildup of crude occurs in US and Europe, which play more of a role in global oil price formation than China, then this may hit prices, the agency said. The sell-off on Tuesday comes despite the market having been reassured by an announcement from OPEC Plus earlier this month, when the cartel signaled a shift away from its previous relentless increase in oil production with a modest rise of just 137,000 barrels per day in November, the same increase as in October. The market welcomed the decision at the time, with Brent crude bouncing by just under 2% to nearly $66 a barrel. So down 10% since then, basically. No, this is Brent. So down 5-6%. Giovanni Stonuvo, commodity analyst at UBS, said the market was largely unimpressed by the IEA's bearish forecast on Tuesday. If the market had been anticipating a massive surplus ahead, then prices should already have fallen to take that into account, he said. Either the market is pricing completely wrong or the estimated surplus is too elevated, he said. I believe it's a bit on the elevated side. Oil prices have also sagged recently as a result of US President Trump's threat to impose additional tariffs on China and amid the easing of tensions in the Middle East with a fragile ceasefire and the release of the final living hostages in Gaza. The recent surplus of crude comes after China and other economies had been increasing their stockpiles, with global observed inventories at 4-year high from January to August this year, according to the IEA. Its estimate of an overhang is in contrast to the view of OPEC, which said that despite speculative activity in the futures market, near-term physical crude fundamentals remained broadly supportive of the market in a monthly report on Monday. It maintained its forecast for global oil demand in 2025 from the previous month. Speaking at the Energy Intelligence Forum in London, Ben Lukoc, the head of oil trading at Trafigura, said that he expected the price to fall below $60 a barrel before rallying. I suspect it will go into 50s at some point across Christmas and the New Year, he said. He says, I don't think it's going to stay there long. We'll see. Okay, now two micro news. No pun intended. Microsoft AI announces first image generator created in-house. Microsoft AI just announced its first text-to-image generator, Maya Image 1, designed and developed in-house. The tech giant, which recently announced its first in-house Microsoft AI models, called the new image generator the next step on our journey. Microsoft says it sought feedback from creative professionals in order to avoid repetitive or generically stylized outputs. My Image One excels at photorealistic imagery like lighting, landscapes, and more, the company claims. And it can process requests and produce images faster than larger, slower models. The model has already secured a spot in the top 10 of LM Arena, the AI benchmark site where humans compare outputs from different systems and vote on the best one. Interesting. This is very interesting because Microsoft has been years behind others in terms of developing their in-house stuff. So this puts them into the game a little bit, I guess. Still a year behind, I think. But My Image One joins Microsoft's other AI products, voice generator and My Voice One AI and chatbot My One Preview. The company was an early funder of OpenAI, but the two companies' relationship has grown increasingly complicated. Microsoft has also started to use Anthropic's AI models for some features in Microsoft 365 recently, and is making significant investments in training its own AI models like My Image One. We haven't had a chance to test Microsoft's new image generator, but once we have, we'll report back on the safety guardrails. The company says it's committed to ensuring safe and responsible outcomes. This is a The Verge article. Okay. And finally, Oracle to offer cloud services using AMD's upcoming AI chips. Oracle will offer cloud services using AMD upcoming MI450 AI chips, the company said on Tuesday, as they rush to tap the booming demand for infrastructure to support tools such as ChatGPT. The companies will first deploy 50,000 MI450 processors in the third quarter of 2026 and further expand in 2027 and beyond. The deal gives AMD another major client for its upcoming chips while allowing Oracle to expand its processor offerings at a time when businesses are rushing to secure compute capacity for developing AI. Demand for large scale AI capacity is accelerating as next generation AI models outgrow the limits of current AI clusters, the company said. I've written articles on AMD and I did highlight MI450 kind of catching up to NVIDIA a little bit. So these announcements just confirm that theory. So I think we're going to see NVIDIA's profit margins decline pretty much. But shares of AMD rose more than 3% in pre-market trading, bucking a broader market sell-off as renewed concerns. I also have a strong sell rating on AMD as well. So both NVIDIA and AMD, both strong sell, as well as Tesla. Oracle shares were down about 1%. AMD last week unveiled a deal to supply AI chips to OpenAI in a multi-year deal, giving the ChatGPT creator option to buy up to roughly 10% stake in the chipmaker. AMD had worked with OpenAI to improve the design of its MI450 chips for AI work, and the startup is building a 1 gigawatt facility based on the processor next year. OpenAI is also reported to have signed one of the biggest cloud deals ever with Oracle, under which the ChatGPT maker is expected to buy $300 billion in computing power for about 5 years. The AI superclusters with AMD will be powered by the chipmaker's Helios rack design. AMD's largest competitor and the world's most valuable firm, NVIDIA, now sells racks or fully integrated systems which include GPUs and CPUs, with AMD rushing to follow suit. All right. And on that note, thank you very much, everybody, and I will chat with you all next time. Take care.